We have Josh Sterling here, who is a really, I mean, you are a real estate dynamo, especially in Metro Detroit area. So I'm excited to have you on today. Like I said, man, I'm super pumped. You can correct me in the numbers here, but I know it's around, you've got 600 units around there that you have that are your own, and around 300 that you manage for other people on top of that, correct? Is that?
Yeah, I'm about 750 right now, and yeah, we're somewhere 250 to 300 third party as well.
Okay, cool. Awesome. And then the other cool thing, and again, we didn't touch on this off air at all, but the one thing I wanted to be two things when I was growing up was a Navy SEAL or a fighter pilot. And you were a pilot, so you're you're almost there. So you gotta talk a little bit about that, but just kind of that transition, because that's kind of your story of going from being a pilot and then seeing I mean, boy, again, you were seeing now like what just happened with the pandemic and what just happened. You got out 10 years before. You kind of, is a black swan event, but you kind of saw the writing on the wall years ago and made that transition into real estate. And so that's, I want to talk about some of your childhood and kind of how you grew up, and then that transition into that, really like what you saw and what was happening 10 years ago that made you realize like, boy, oh boy, I need to make a change here.
Yeah, well, so first of all, being a fighter pilot and being an airline pilot are nothing the same. I was just an airline pilot. It's like driving a bus in the sky, so it's not that cool, actually. But yeah, as far as stage writing on the wall, I didn't see that at all either. I just did what I'd always been told to do: go to college, do well in school, get a good job, buy a house for yourself. And I did all that leading up to the recession. I was in the airlines from '05, and I left in 2010. And what got me into real estate was that there was no control over my income, over any job stability. And so at one point I got a downgrade from a captain to a first officer because the airline was shrinking, and it was about a 50% pay cut with basically 3 weeks notice on it. So I went from getting by with a bunch of student loan debt. I had a house that was upside down because of the recession, and to looking at what I was going to have coming in income wise and realizing that it wouldn't even make ends meet. Which is pretty frustrating when you haven't really, you've done everything you're supposed to do or told you're supposed to do. And so went out in '09. I thought, man, real estate really seems like it makes sense. It's, you can purchase a house for, at the time, I can be all into a house for $40,000 in a decent area. It'll rent for, at the time, maybe $1,000 a month. And I'm running the numbers on it. And it made sense. So that was kind of what kicked me into it. I had a few bucks. We mostly scraped together 0% credit cards, and I took some personal, like, unsecured debt out and bought houses that way. And it just kind of grew literally from one house. September of '09 was the first house to today. I think it's about 750 units and another 70 under contract.
Wow. That's incredible. And then really quick, taking another step back, where did you grow up? And were you in Metro Detroit, or what was kind of that childhood?
So I grew up in Lake Tahoe, California.
Why are you here?
It's you only move to Michigan for two things: for love or for money, right? So I had gone to school in Daytona Beach. I was flying around the country as an airline pilot, and I'd met my now ex-wife, but I'd met my wife in Vegas, of all places. She was from Trenton, which is downriver area. So I started coming up here and just kind of got established here. I started buying property here, and eventually took a job as an air traffic controller, which was much more stable than the airlines, and just kind of got rooted in here.
Wow, interesting. So that's that. I guess that leads to that. And then, now what was the I mean, I guess obviously you had the wife, the family there, and that's kind of probably why you were here and started building here. I mean, is it something like if you look back, I guess, would you say like, hey, I'm glad I am now here building my portfolio and building stuff here in the Midwest? Or is that something you're like, oh man, I could have been somewhere else doing this somewhere else?
Well, no, I think it was kind of a blessing in disguise. I didn't realize it at the time, but flying for the airlines, I was traveling all over the country, all over North America. And I really didn't, I would see, I started looking into, home prices and quality of neighborhoods. I'd be, stuck, let's say, in Denver for the night or in San Francisco or whatnot. And you'd look around at what houses were selling for versus what houses were renting for. And you don't hear people talk about it, it seems like, much anymore, but I used to always just look at the price to rent ratio and what it was in this area. And the key was, it wasn't like we were in the slums of Detroit. I mean, we're buying in pretty decent neighborhoods. The price to rent ratios were just far better than most other places I'd seen.
Yeah.
Turns out you can get that in most of the Midwest. I've found out later, but it was just kind of a blessing in disguise that I ended up here and had the comparison to these other markets.
Yeah. What's and you kind of touched on this a little bit already, but you had, you get taken on credit lines, different stuff like that. How were you raising money or using money of your own, raising money from other people, just unsecured credit lines, or like how were you doing all that and funding a lot of those first? Because I think in the beginning you had, I remember you saying somewhere on another podcast, it was like 24 single families, and then you had a 24 unit you bought. Is that correct?
Yeah, once the process of raising the capital, it was actually pretty simple. I had no money. So one thing I did have going for me, I had a couple $100,000 in student loan debt, upside down house. I mean, it wasn't looking good.
Right.
I was making $35,000 a year. I mean, not good. But I always had good credit. I never had any late payments on anything, even through the recession. So that helped because, especially back then, banks were offering all kinds of what I used to get a lot was 0% credit cards with balance transfer offers. So you could balance transfer the money to a checking account. So we ended up buying, between that and some creative lines of credit, you'll see lines of credit offered all the time through like a Citizens Bank or just a local credit union, whatever. They would offer, 25,000 here and there, or 50,000 or whatever that line of credit might be. So I took as many of those as I could get. And they'd come in the mail. Literally, I didn't know where to look for them. And that allowed me to get up to a couple of houses that were technically free and clear. They were free from a mortgage.
Right.
Once I did that, really the turning point for us was probably early 2010 sometime. I called around to a bunch of different banks, figuring that I've got all of this, I've got at the time a few houses, I owned 5, 6, somewhere in that range that were free and clear. And I said, hey, if I can just take the equity in those and borrow against them, kind of packaging them all together, and at the time, the reason I wanted to package them together is because they weren't really high valuations. They were still only worth maybe $50,000, $60,000. Right. So I figured a bank wouldn't want to do a mortgage for, $40,000.
Right.
So package them together. Now we've got some value. And I found just that. I found a local small credit union that would package. At the time, the first loan we did was 4 properties, and he gave us $100,000. Which to me might as well have been like $10 million, at the time. It was like $100,000 at once. And that's what we took off to the races. I went out and within a week had 4 more properties under contract. I had to start hiring contractors because I couldn't do the work myself anymore. And that really propelled us into growth. And then it was just a rinse repeat. Even to this day, we'll still package groups of single families or refinance an apartment and recycle that money back into buying more property.
Yeah. Yeah. Would you say, because I know, like, again, you look at the Kiyosaki's and the McElroys and all those, a lot of the big gurus or whatever, and that's what they talk about all the time, right? Is using that money, refinancing, adding value, increasing the NOI, right? And then pulling the money out, leveraging it, and then going to take that and buy another asset. Is that kind of that process that you've been doing? Because that was kind of my next question was, how are you doing it now? Are you doing a lot of that and using that leverage and using that equity from your assets to go buy more? Are you going raising money still from outside, or using a little bit of both? How are you doing that now?
Kind of all of the above. So it's different, with single family. I'll talk first. Single family, if you think about it, someone who flips a house, right? What they do, they buy a house. I'll pick today's numbers in a market we might be in. You might be able to buy a house for $80,000 that with about $20,000 of work. So let's say you're all into it for $100,000. You might be able to sell that house for $150,000 if you did a good job and bought a good deal and flipped that house. You might sell it for $150,000. So all I do is, instead of selling that house and chopping down your tree, if you will, I buy them. I get a few at a time, and we will refinance that house. So let's say that it appraised for $150,000. We would refinance it, get probably 75% loan to value in this market. So that's what, $120,000 loan. But I'm all into that house for $100,000 if I did it right. Yep. We just have to do it 3 or 4 at a time because you need some scale to do it, and it's called a blanket mortgage. So it's the same idea, except I look at it like I flipped the house to myself. I'm keeping the house. I'm keeping the cash flows. I'm getting the principal pay down now. I'm getting whatever appreciation might be there. I'm getting all the depreciation. If you flipped any houses, you know what happens come tax time. So there's a huge benefit there. And that's all just off of comp sales, for single family. We don't do as much of that anymore because they're pretty hard to come by. It's hard to scale. If they fall into our lap, we'll do them. But on the multifamily side, like you mentioned, it's all about raising rent, raising the NOI really. So typically raising rents, sometimes decreasing expenses. A higher NOI will get you a higher valuation at whatever multiple cap rate is.
Yeah.
So we add value that way too. And then as far as sources of capital, yeah, I'll recycle my own. Obviously, that's ideal, right? You can
Right.
have 100% control of the deal, 100% of the benefits that we just listed, but we'll also raise capital too. So depending on the size of the deal or where I'm at in a growth cycle, how liquid I am, I'll syndicate out a deal. And so now I've got a guy who I give a cut of equity, and he will go out and actually raise the capital, and something
Oh, okay.
I never liked doing. And that's how we source capital for the occasional deal.
Oh, okay. And those are generally, I would imagine, especially in the multifamily space, doing private property place or private placement memorandum,
Yeah,
stuff like that. Correct. Yeah.
yeah, exactly. So, we're typically doing it really depends on who's in the deal, but either a 506B where you can have non-accredited investors. That's how we used to do multiple. Now they're typically 506Cs where we need accredited investors, but we really kind of look at the deal and who's going to be in that deal and make that determination there.
And then just for people that aren't clear either about those two differentiations, I know there's one of the big is marketing, right? Like which one is which, where you can market one of them, but you can't market the other one, correct?
Yeah, the quick rundown on consult your attorney on all this as usual, but
Yeah, right.
offering. Well, first I'll start with an accredited investor. Being an accredited investor has to have net worth over $1 million, married couple over $300,000 in income. I think it's 200 if it's a single person, and they're considered accredited. If they're not qualifying under those terms, and they'd be what's called a non-accredited investor. And why that matters is now there's two general categories under the Reg D offering that you would file. One's going to be a 506B as in Bravo. One's a 506C as in Charlie. So the 506B, you can have up to 35 non-accredited investors in the deal, which is typically plenty. If you're doing a deal under $10 million, you're probably not going to have more than 35 non-accredited anyways. That's not usually limiting on a small to mid-sized deal.
Mm-hmm.
The key is you cannot advertise that deal to the general public. You can't go out and post that over Facebook and put a billboard, whatever the heck you might do.
Yep.
Shifting gears, the 506C, as long as everybody is an accredited investor, you can advertise that deal. And so that's a main benefit of that. The other significant factor is on a non-accredited deal. So on a 506B offering, you have to do audited financials, which I've always thought was silly, because here it is typically a brand new entity you've formed, and you have to have a CPA audit financial that costs a few $1,000s, takes some time, but on a 506B, you got to do that as well. And there's a few other intricacies that our attorneys always advise on, but those are the big picture items to me.
Nice. Yeah, cool. Thanks for clarifying that. What do you, I mean, because I feel like you touched on something kind of right when we got into that, which was you're basically flipping it to yourself. And that where I feel like that for whatever reason, that is not the way most people go with that. It's like we always, the flipping the houses is a sexy thing to do. That's the thing we all, there's the shows, there's this and that. I mean, what are your thoughts as to why people generally just go flip the property and then meet the tax man at the end of the year instead of flipping to themselves, taking out the leverage, then not chopping down that tree like you said? I mean, what do you think is that? I still haven't figured it out myself. That's why I'm asking you. I'm super curious as to why.
I don't know. I think a lot of people think if they can just get a little, because you obviously get 100%, minus your cost of sale and whatever you're going to pay for taxes, but you get all your money out instead of maybe 75 or 80% loan to value. I think that's one. I think number two, a lot of people probably aren't aware of the concept of packaging these together in a blanket loan and refinancing them. So that's gotten more and more popular. But I can tell you in 2010, when I started doing this, I don't know of a single person that was doing it. Had this lender not proposed that to me, I would have never known it either. And then, the same with wholesaling. I think it's guys that just want to churn properties and think that the quicker that they can get in and out of one, the quicker they can get in the next. It does take a little bit of time to go out and get the loan and get them, acquire the properties, get them all fixed up, get them all to appraise, get the loan. It can be quicker just to finish a property, list it for sale, and be done.
True. That's you probably summed it up right there at the end of the best. Short-term gratification versus long-term gratification, right? That's our society is an issue with that. What does so like kind of that process is someone, again, we kind of touched on this a little bit, but what that process of raising money, to say it is a single family home or whatever, is something that I was telling you earlier. We're doing a lot of this right now. Raising money. What do you think are some pitfalls or some things that people run into, or maybe some things to watch out for when you are raising money, when you're kind of going down that road? Some things that maybe people should think about, or maybe pitfalls or some things that people might run into
So, I mean, there's really, in my mind, there's two different categories you raise capital in. One would be on the multifamily side, which we just talked about with typically a Reg D offering, you get your PPM and whatnot, right? And that's going to cost some money for the legal docs, but that's for a bigger deal where you might be raising, our typical raise is going to be somewhere between $1 million and $3 million. If you're doing a $10 million deal, it's roughly a $3 million raise, right? That's a little bit different than the single family side. You can do what we just talked about, where you purchase a property, put a little bit into it, get it to appraise at a higher value, rent it out, and get a loan based on that appraised value. You can do that with just raising capital on an individual property basis. So it doesn't have to be your own money. With those examples I just gave you, the $80,000 house where you're all in for $100, effectively with $400,000, you don't ever need another penny ever again if you think about it, right? You're just going to recycle that capital. Yeah. So that $400,000 doesn't have to be your own money. I'm making some rounding errors, assuming no closing costs, no interest or anything on the money. But if you borrowed $400,000 from a private lender, even if it was at 15%, like some of these are, and they record a mortgage on each house, you're going to pay them some interest and some fees at the time of refi, but you could do this without any of your own money. And so I think that's something that people, overlook, is going out and there's a lot of money available in this economy. There's private money that will attach a mortgage at certain loan to value to a property, especially for somebody that gets a track record behind them.
Yeah, that's huge. Yeah, and right there, I think you said that huge. It's huge too. The last part, which is getting a track record behind you, is so key. Cool. Well, let's take a little bit of a turn into just kind of what you're doing now. You have the investment side of what you're doing, which feeds your property management side, or vice versa, depending on how you want to look at it, I guess. But so how did the property management company, Epic Property Management, come about? And what areas are you guys handling? Single families, multifamilies, kind of how did that transition come about? And then what are you guys providing, I guess, nowadays?
Sure. So property management came about because I had no other option. I did not want to be in property management. It's just the necessary evil. When you look at large multifamily deals, there's really three pillars, three legs of the stool, right? You need the capital to close the deal, right? So the funds you raise, whatever. You need the deal itself, and then you need the operation or the management of the deal. And typically nobody thinks about the management of the deal. They think, I'll just hire a management company. They don't think about that until it's too late. I know of numerous groups that have started down that road, got deals, raised capital, and then they can't run them. And I saw that when I got to about 50 doors, I realized I couldn't really run this on my own. At least if I wanted to, it wasn't going to be fun. And what's the point of doing this?
You still had a job at that time too.
Yeah, I was a full-time job trying to basically self-manage. I got to about 50, and that's when it got got very rough. And so I looked to hand it off to local management company or two. There was really one in particular that was kind of the only show in town at the time. And they, in my opinion, they weren't going to run it the way that I thought we could and we should and we had been. So we were formed. So Epic Property Management was formed over that. And, we've grown, obviously, as the portfolio has grown. We've taken on third party as well. And we I think we provide a management on a different level than what you see. We've got some really unique things on our website. We list some of these, but we call it the Epic Advantage. But I mean, some silly things that you don't see other management companies do. Like we're open every day from 8:30 a.m. to 7 p.m., 10 to 7 on the weekends, 7 days a week, we're open that late. We've got 17 vehicles out on the road right now between leasing agents, all of our maintenance staff, cleaners, everybody that's out, office managers, project managers. They're all in marked company vehicles. They're all uniform staff. So we operate that single family house or that 20-unit apartment building the same way that we operate that 150-unit apartment building with a much more professional touch. One of the recent things we did is we spent about the last year and a half developing a custom software that automated all of our workflows, mostly the turnover and maintenance processes, but also tracking our lease up and our checklist driven systems into one software with a dashboard and notification system that really automated everything we do operationally. And it was a huge time investment, a huge capital investment to get there. But it's just something that we use a third-party management software. We use Buildium, and it's great for what it does for 95% of it. But that other 5% of the detailed operational systematic stuff, we couldn't find that anywhere. So building that on our own, it really improves efficiency. All of our maintenance staff has iPads out in the field. So when they complete a work order, we know real time. instead of that person getting back to the office at 5 p.m. and saying, yeah, that work order is done, we can now move on to the cleaning phase of the turnover.
Mm-hmm.
Our office knows at 10:05 or whatever it is that they finished that work order, gets an instant notification, and can schedule that next phase. And it just speeds our process up, makes us more efficient, which, saves us money and saves the owners who manage their money in the long run.
Yeah. What areas do you guys operate geographically? And is single family, multifamily? What does that all look like?
Yep. So we've got 3 offices right now. We've got one in Dearborn Heights. Our main office is in Southgate, and then we've got an office in Monroe. We operate properties all the way from Toledo up to the farthest north is going to be East Point, Warren, somewhere in that area. Shelby Township. We do not do Detroit. We go as far west as Ypsilanti, but we made a decision a while ago. Some guys do well in Detroit. That's just not our cup of tea. We're typically a little bit higher end property. And we generally don't find those in Detroit, so it just doesn't quite fit the mold.
Yeah, exactly. And then the single family, multifamily, is you kind of run the gamut there basically?
Yeah, so we don't tend to third party manage too many multis. We have the ability, we manage obviously all of our own,
Right.
but mostly that third party stuff is single family. And it's probably due with our cost structure. We're probably not the cheapest out there. We charge $99 a unit. Flat fee. I believe in the flat fee all day long. And so on a multifamily, we'll discount that to $79 once you get over 24 units, but it really doesn't, it's pretty hard to have a $500 or $600 a door rental pay, even $79 a door for management. But, again, with all the systems and processes and staffing and infrastructure we have in place, we just can't really do it any cheaper. Management's kind of a break even for us. So we tend to not be the best economical choice, or I should say we're not the cheapest for multifamily.
Yeah. Which, at the same time, because of the systems and the process you've built, it allows you to kind of view it all and say, hey, this is where we need to be at. This is where we're comfortable being at. It allows you to do it.
Right.
Unlike most management companies who can't see that data and that scale and make sound decisions. So that's
right. And, it's ironic because even though, we might be a touch more expensive than some of the other management companies, and in a lot of cases, we're not any more expensive, but I can guarantee our systems, we've got data that shows, what we track for occupancies and our turnover times and just the processes and systems in place. Over time, it saves the owner money, but it takes the right type of owner to see that. Some guys are just going to look for the 5% of gross rent type management, and you get what you pay for.
Boy, oh boy. Yeah, I don't know if I'd ever touch a 5% gross management rental company or management company, but that, which again, kind of leads me into what was that catalyst? Was again, off air, we were talking a little bit about just mindset, I guess, and so many investors just have this mindset of like, I've got to do it on my own, and not seeing the bigger picture, not seeing that scale. What helped you? What was like the catalyst? And maybe it was that early on, that being that 24 units going to 48, 50 units. But what was that thing where you not necessarily that you realized you needed to build your own management company or like do that, but what was that, what made you really think like, I want to be bigger. I want to get that economies of scale? Because again, so many people don't have, it's just like, it's so limiting, right? The limiting mindset of like, and what was different for you? I guess, did you have that internally already? Or is it just something like one day you're like, I am not doing this anymore. I'm either out or I'm building this the right way. What kind of happened?
That's exactly it. I think it's interesting when you talk to people that, get into buying investment property, you kind of have really, 3 schools of thought. I'm going to generalize here, but number one is guys that are going to get into this. They're about to buy their first property. They're commonly found at your local real estate meetup, but they're just always about to do it. They really never make that first step. Yep. Right. And then you have guys that get in and they try to run everything themselves, right? They're going to self-manage. They're going to, they're sometimes out there doing their own maintenance, their own showings, all this stuff. And while they might be able to run it cheaper by not counting what time they have in it, they limit themselves, and it's pretty much impossible to manage over 50 units, I would say, single-handedly. There's some number in there, maybe it's 40, maybe it's 60.
Right. Depending on the person.
You're going to plateau. And if you look around, you'll talk to a lot of guys that start to plateau around that 40, 50 unit mark. And that's typically what it is. They don't have the systems, the operation in. It's hard to grow if they don't do it. And then the other, the person who grows larger, or the team that grows larger starts to either sub out management, and that's one approach, or bring management in-house and hire teams and systems and people to do that, which you go from having a real estate business to, once you start hiring employees, it's almost just like any other business, right? And probably 85% of the issues and the things we have to overcome in my business today are not really real estate related. They're
Right.
they're business related, and it's
People related.
at a shoe store, you'd have the same problems that I have running a property management company. It's people related and systematic business related processes that you have to somehow overcome or implement new processes there.
Yeah. It's something, I can't remember who said it now, but it was something to the effect of like when you're getting into real estate and you start kind of scaling up and you got things running smoothly and systems and processes, it's really more, real estate is an accounting function. That's all it is. It's just bookkeeping and accounting. That's what the business is. And like you said, if you start scaling, then it becomes a people business, more of like, hey, I'm dealing with my own employees or I'm dealing with people there. So it's interesting you say that. What was the transition really from, because I know initially you were doing your stuff internally and then you started to go external, I believe, in the last 2 years. What was that? What made you kind of make that switch?
You mean as far as like taking on third-party
units?
Yeah.
Yes.
We've been actually third-party managing units for probably since 13 or 14, pretty early on. Never really promoted it too much because we don't actually make money managing property. So it's not something we really push. Every once in a while we've made a little push for it to build some scale. But for us, it's always been a scale thing. You know, if let's say we manage an extra few hundred units, now we might be able to have an extra maintenance person or maybe an extra project manager, which improves our processes and our operation. You know, but really getting into building the management team, if you go back to, like, I'll think back to when I had maybe 50 units and I realized I tell people this all the time, that if you're not going to get in and get any type of scale, at least 20 or 30 units, you might as well not get in at all. If you get in and get 3 houses, 4 houses, you're going to have too many ups and downs. And you know, that one move out where you have a huge turnover or that furnace that goes out, it's going to take your cash flow for the entire year. Once you get a little more scale, you start to see the ups and downs at least flatten out a little bit. And so, you know, I realized when we were at about 50-ish units that if I'm going to do this, I need to go for it. I need to have, you know, hundreds or thousands. I've always said I want to get to 10,000 units. You know, I don't know that I care that much about that number anymore, but I've always realized that I wanted to grow this, you know, bigger than just a part-time thing.
Yep. Well, yeah, that's awesome. That answered my next question, which was how big do you want to make it? Because I think that's always that the focusing on the higher image is what makes people who are successful grow a lot. What do you think, transitioning now a little bit away from that, but in just more of like a general sense of the market? We touched on this a little bit off camera. And what do you see? I mean, again, you see a lot of data, you see a lot of, you know, people coming in and out, and maybe you could touch on a micro level of like, what are you seeing for lease ups and what's kind of the retention there? And then all the way to like, what do you see? What are your thoughts in the market head, like this year, rest of the year, and then going forward? What are your thoughts? What is your crystal ball see?
It's broken. So as far as I can tell you our data. So, you know, on our level, in our world, what we see, which call it 1,000 doors, we're seeing through the Metro Detroit area in Northern Ohio, we are seeing what is probably the lowest ever vacancy. I mean, at one point, out of almost 1,000 doors last week, we had 4 available units, which is incredibly low vacancy, like in the 0.1%, right? Better than I've ever seen. Collections are surprisingly strong. We track collections on a regular basis, and you know, obviously, everyone was afraid with COVID what would come of that. But you know, my belief is probably what was pumped into the economy, not only with a little bit of stimulus money, but the unemployment rate. You know, unemployment basically makes minimum wage $25 an hour right now. So everybody's got money right now. We've seen really not much of an issue with collections on the residential side. Some of my retail portfolio suffered a little bit, but has since bounced back with probably the PPP money and some SBA money that's out there. Yeah. So time will tell what will come with that. Going forward, you know, we talked a little bit before we started here. I am completely shocked that interest rates are what they are today. If you'd asked me 2 years ago, I'd have said for sure they'd be higher. And in fact, they're down. And now it looks like, you know, the Fed won't be raising rates until 22 at least. Yeah. And so to me, that's incredible. As far as real estate prices, I've never really been a believer that, we're due for another crash. You know, I think that the 08 to 10 timeframe might have been somewhat of an anomaly, but I also have, I guess, been wrong in saying that rent growth cannot sustain. I mean, rent growth is up 50% in the last 6-7 years, you know, in a lot of our properties. So I don't see how that's sustainable when incomes haven't grown by that rate. Right. At some point, they can't keep diverging. And so, for us, when we underwrite a deal, especially a larger multifamily deal, we're typically going to underwrite that off current actual rents or even a discounted version of that, because I really don't see how rents are going to keep growing. If we end up buying the deal off of those metrics, off that analysis, and then rents do grow, it's just a bonus to us. But I think the guys that are out there underwriting deals off of a potential rent growth or projecting the same rent growth linearly into the future, I think it's a recipe to get in trouble.
Yep, absolutely. Like you said, 10 years ago, that wasn't that long ago, how quickly people forget, right? That's boy, oh boy. What do you, really quick, actually, just a couple more to kind of to wrap up here, but what, when you go to underwrite a deal, are you still underwriting yourself? Do you have a team that's doing them, or how does that process work?
So I'll do a lot of the broker connections, which is where a lot of our deals are going to come from, are going to come right to me. I'll underwrite a lot of the deals. It's a pretty quick process. 99 out of 100 we can't even touch.
Right.
It seems like, especially lately. But
right.
I'll typically underwrite them. The guy that raises capital for me, I've got him to the point where he can at least get the initial underwriting a lot of times.
Oh, nice.
He'll do them, and I'll give it once over. But to underwrite a multifamily deal is a couple minute process.
Right.
It's not usually a big deal.
Right.
Initially.
Yeah, exactly. Cool. And then transitioning last couple of years, I know we've been on for a little bit, and I want to be wary of your time. Some things you're studying. What are you studying right now? I know we talked about some books beforehand and stuff like that, but books you're reading, YouTube people you're into. What is Josh watching or studying right now?
So like we talked about earlier, it's when I first started, it was all real estate books, learning all about acquiring houses, financing them, about acquiring apartment buildings, analyzing apartment buildings. Not that there's not still stuff to learn there,
right.
But for me, my interest really in the last probably 4 or 5 years, but specifically in the last couple, is more about running a business and how to better and more systematically run that business, and that involves removing myself from the day to day, right? The bottleneck's always at the top. So I've got, that's always been my goal, is to work myself out of the day to day. I think we've done pretty well with that. I'm in a business group called EO, Entrepreneur Organization, which is amazing. It's all other business owners in every different field you can think of with, they've got employee problems and they've got growth problems and capital problems and all these businesses. We all have pretty much the same issues at some point.
Yep.
So that's what I mostly focus on is how to better operate that business and how to be a better entrepreneur.
Yeah, that's awesome. And that's what Andrew, we were talking about earlier, that's what he had mentioned with you.
Yeah, I actually referred Andrew into EO.
Yeah, that's what he was saying. So it's cool that you just mentioned that. So, and then it kind of transitions me in the last 2 years, but what's the biggest factor of your success or just anyone's success? What do you think the biggest thing is that helps people or will get people, off their butt to do their first deal? Or what's that big factor you think or that people need to have in order to really be successful in real estate?
It's tough because obviously you need the analysis and you need a little bit of the research that goes into it. Mm-hmm. But the truth is it's 80% just go for it, right? It's like ready, fire, aim. And if you're not willing to go in and make that jump and make that first deal happen, we always say I coach a little bit of syndication for one of the big podcast operators. And, he has a theory that I completely agree with that first deal what is it called? The art of the first deal or something along those lines. But once you get that first deal under your belt, that second one is so much easier. You've got the confidence to do it. You've been through the processes. People believe that you can do it now, right? So getting that first deal done, it takes is key.
Yes, love that. Great advice. Anything else that you could think of, want to share about real estate in general, Epic, anything at all?
No, I mean, if you want to check out Epic, you can get to our website, epicpropertymanagement.com. Take a look. We've got a tab called the Epic Advantage that talks about some of the things we do that I think are unique to the industry. And take a peek and feel free to reach out to us.